The United Kingdom has decided to print money to save the economy. Now, the Bank of England has done a historic pivot towards QE infinity. Instead of hiking rates, they are now buying as many bonds as possible to stabilize the markets. And we already know the British pound is getting destroyed and about to hit parity with the dollar, but things just got worse, guys. And if you're in the UK, the economy is on its way to a stagflation hell. And just this week, bond yields of the British gilt soared to new highs. This collapsed the entire bond market and the Bank of England capitulated. They are now buying £5 billion of British bonds a day, and this will go on forever until they restore order to the markets. I think we have really reached a pivotal point in this inflation fight. Remember, inflation in the UK is at an insane 9.9%. And if you want to solve the problem, the only way forward is demand destruction. But the central bank flinched, right? They chose to save the market and avoid temporary pain. Instead of fighting the inflation giant, they have traded in an economic recession for an inflation hell. And here's the catch. A recession will still happen, guys. It is unavoidable at this point. And what we are seeing is a collapse of confidence in the UK economy. And this started because the new government, headed by Liz Truss, decided on a very weird plan to stimulate the economy out of a recession. Her idea is to give tax cuts to everyone, including the rich, putting more money in their pockets. She believes it will boost production and solve the supply side problem. And according to the plan, corporate tax increases are cancelled, personal income tax is cut by 1%, and the rich gets to keep more of their earnings. Now, this sounds good on paper, but it is the exact opposite of what is necessary to destroy inflation. And in order to fund the tax cuts, the government is going to get into even more debt, right? Borrowing an extra £72 billion. You are trying to sell more unwanted debt into a market that is fleeing bonds like the plague already. You are introducing more money into the system and pushing down bond prices. And when the markets realized that, they began dumping British bonds and the pound sterling as well. And here's the thing, it is impossible to fool the markets. They know this is just feeding the inflation demon even more, and they decided to run away in one piece. So this action set in motion a deadly chain of events that made the Bank of England do the unthinkable. They decided to print more money when inflation is still soaring. You see, there are two types of policies that affect the economy. The government is in charge of fiscal policy, which means taxing the citizens and spending money. And governments, especially in the United States and the UK, they love to spend money to make everyone happy. However, the central banks, they are in charge of monetary policy, which is very different. This is either expanding or contracting the money supply. And almost every central bank today is tightening because they know demand has to come down. All except the Bank of England, because their government spending habits have triggered a collapse in investor confidence. So now they have to print money to save the day. And to understand what triggered this bond market collapse and a subsequent bailout, we need to talk about pension funds, guys. Pension funds, they are in charge of managing old people's money, and they are focused on giving them a fixed amount of return every month to survive on. And to do this, they focus on buying government bonds because they know how much money they need to pay out, right? Maybe it's $100 million a year, maybe it's $500 million a year, but it's very predictable. But the big problem is over the last decades, yields have been falling. We can see just back in 2020, the yield on a 10-year gilt was at most 0.5%. That is a terrible yield that won't give any decent return. And to solve this problem, pension funds decided to design a better mousetrap. They began using what is known as liability-driven investments, or LDI. They were basically derivatives to leverage up and gain a better return on their capital. So they were using like £1 in capital to control maybe £3 or £4 worth of bonds. And this allowed them to magnify their returns. So instead of just buying the 10-year gilt outright and earning like a 0.5% return, they used derivatives instead. And this allowed them to enjoy the equivalent of maybe 1.5% returns, 3 times the amount on the same capital. But we all know the catch, it also magnifies their downsides. Now, another way they were investing is by borrowing money by selling short-term bonds like the 2-year gilt, which had a lower yield a few years back versus the longer-term 10-year gilts. So they borrowed cheap money that way and bought more 10-year bonds to gain more profit. But all that changed when bond yields started to soar. So just imagine you are a pension fund manager taking money from the elderly, right? More or less speculating on derivatives, and everything was going well. You could leverage up and give investors a decent return even though rates were near zero. But suddenly, central banks were hiking rates, and now you have margin calls happening, right? Your old strategy is collapsing, and now you are sweating. And because rates are rising, this is pushing up the cost of borrowing and sending bond yields soaring. And we can see an insane rise of the 10-year gilt from less than 1% to over 4% in just 9 months. That is a crazy jump that has destroyed the bond markets. So if you're a pension fund, you're getting attacked from all sides, and because you were using derivatives, you had to come up with cash to make the margin call. And to come up with cash, you need to sell your bonds, which made bond prices crater even more. And this is a bond squeeze. Plus now, the 2-year gilt yield is higher than the 10-year, and this means the cost of borrowing money for the pension funds has just gone up. So now they are losing money on the margin calls and losing money on borrowing costs. And this forced the Bank of England to step in and bail them out. The central bank went in to buy as many bonds as possible to prevent pension funds from going bankrupt. They are buying up at least £65 billion worth of them, because if they don't, we are talking about a possible $1 trillion meltdown and 20 million pensioners at risk. Remember, this is not private investors buying up the gilts, it's the Bank of England, a central bank. This is debt monetization. This is creating money from thin air to stabilize the markets, and we all know what this means. The money supply has now increased, there's more money chasing fewer goods. Back in 2020, banks around the world started to print trillions of dollars, especially the Federal Reserve, and it takes time for inflation to work its way through the system. And we can see back in 2020, the Fed printed $5 trillion, taking their balance sheet to over $9 trillion. But inflation wasn't instant. It took around 1 year for inflation to spike above 2%, and then it headed north all the way to 9%. And this is the same thing that's going to happen to the inflation in the UK. It's just a matter of time. The markets were actually working right, investors were correct to exit British bonds, but the government didn't like the outcome. They were trying to solve the consequences of high inflation by pouring gasoline on the fire. So right now, it seems that the British pound has recovered over 3% after the bailouts, but it's just going to be temporary. The markets are stabilized and the pension funds have not collapsed, and investors are happy for now. But this is just kicking the can down the road. The bank has traded a recession for an even bigger inflation monster down the road. And here's the crazy part, we even have the IMF scolding the UK for this disaster, telling them to rethink their tax cuts. Ray Dalio himself mentioned that the UK government is operating like the government of an emerging country, and it's really easy to see why. The trust tax cuts are the second largest in history. She's giving away money in a period where the traditional move is to take money out of the system. And this could also cause Moody's to downgrade the UK's credit rating. So just imagine one of the strongest economies of the world getting downgraded like an emerging economy. And if that happens, it will wreck the UK markets even more. Bond yields are going to shoot through the roof once again. And we're going to understand that investors today are very uncertain about where to put their money. They're going to flood into US dollars even more now, and the UK government's borrowing costs will soar even further if a downgrade happens. So the UK is really caught in a bind now. On one hand, you have the Bank of England printing money to stabilize markets, but on the other, they are already planning a jumbo rate hike in November. And this is really a bipolar situation where you have money flooding the system and rates are going to pull money out of the system at the same time. It's like trying to go forward and backwards at the same time. And that's why the UK might be entering a prolonged period of stagflation, guys. We have been talking about how interest rates needs to be raised and held high for a long period of time. But just imagine, now you have high inflation at the same time. It's really disastrous. Now we are in October and things are really this bad. Just imagine once we move into winter, which is just like 2 to 3 months away, we are going to see stagflation get even worse. It's going to be part of the British experience very soon. And the story is going to get even darker. We know Europe's economy is going to slow down dramatically once winter hits. Russia's not going to turn the gas back on, the Nord Stream pipelines have been sabotaged, so the Eurozone can kiss goodbye to cheap energy, and this is just going to crush the British economy. We can see that 42% of all UK exports were to the Eurozone, and this is a very big problem, especially when winter is coming and energy prices are going to soar there. People from the EU will not have money to buy British goods. Their cash is going to flow into food and electricity. Plus, China and the United States, they are all slowing down, so they can't save the UK as well. People around the world are simply too broke, and the UK is on the brink of a recession. The official GDP numbers in the UK just came out, and it's not very encouraging. June's GDP was negative 0.6%, and July was only positive 0.22. The trend is sloping downwards, and by August, we could have negative GDP again. In fact, the ratings agency S&P Global already believes that the UK is already in a recession that started in Q2 this year. And it's only going to get worse as the situation in the EU gets darker. But at the same time that the economy is contracting, we have even more spending, right? The UK is rolling out energy price caps and about to throw billions of dollars in bailout money again. We have a £40 billion bailout for British businesses like pubs and manufacturers and £130 billion for households. Now, the good news is that people won't freeze in the UK, but this deficit spending is going to boomerang back. It's going to manifest as another wave of inflation once the money works its way through the system, right? And once winter is over, we are going to see even more rate hikes from the Bank of England to wrestle it down again. The inflation problem is just being kicked down the road, but this time it will be an inflationary recession, the worst of both worlds. I really don't want to sound like an alarmist, but a day of reckoning will come. The UK has chosen to delay the pain to 2023, and all this money printing is just going to make stagflation last longer. Now, the trillion-dollar question is, if the Federal Reserve will pivot as well, will Jerome Powell do a 180 and start printing money like the Bank of England? Now, I believe many people are in the camp that Powell will chicken out the moment something breaks, right? Maybe it's the stock market collapse, or maybe it's unemployment rising, but the Fed will pivot at the first sign of trouble, and that's the common belief. But I think we need to take a step back and cancel out a few possibilities. We have already seen Powell staying resolute and telling the whole world that rate hikes will continue no matter what. He specifically said, "History cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project and will keep at it until the job is done." He knows that if you start printing money before inflation is wrestled down, you'll just cause a longer period of inflation and drag out the recession even longer, right? I believe the situation in the UK has strengthened his resolve to keep hiking. I don't think he cares about the stock market and if it plunges all the way to hell. Now, will it be a dollar crisis that will force the pivot? I really don't think so as well. The dollar index has been on a non-stop tear, rising from under 95 all the way to 112 today. People are rushing towards the dollar because it's the reserve currency and the slowest ship to sink. It is still seen as a safe haven during times of crisis, but what I think will be the breaking point for the Fed will be the unemployment rate. We need to circle back to the Fed's dual mandate. They are in charge of keeping prices stable and ensuring maximum employment. So if people start losing their jobs and the outcry is bad enough, then maybe we could see a pivot. But surprisingly enough, guys, the US jobless claims have fallen in August, showing that there's still demand for workers. But we know the truth, people are working harder than before, right? Sometimes taking on 2 to 3 jobs just to make ends meet. But to the Fed, they don't care. It shows a strong economy, right? A strong economy and no reason to stop any rate hikes. And I think the chaos in the UK is a preview of what's going to happen down the road. This time it's British pension funds. It might be rising unemployment in the United States tomorrow, but there will come a breaking point where central banks might be forced to pivot. And this is the big danger because there's no way to solve high inflation without demand destruction. You can't solve the supply side of the equation, and to destroy demand, you need a recession. I think when the time comes, governments will need to choose between economic stability or the value of their currency. And it seems the UK, at least for now, has chosen to save their economy as a whole, but they have unleashed the inflation demon. The markets are going to see through these bailouts and realize that inflation will work its way through the economy sooner or later, right? Maybe it will be in winter, maybe it will come in 2023, but you cannot print money forever without consequences. And as the Fed continues to hike rates, we could see the pound sterling continue its crash down to parity. $1 might equal 1 British pound very soon, and there are a lot of hedge funds betting on this outcome waiting to pounce. So let me know what you think. Is the UK heading towards an inflationary recession? Will the Federal Reserve eventually pivot like the Bank of England? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these inflationary times.